I'm just wondering how you feel about the week that we've had so far when it comes to Chinese equities. Your old shop, Goldman, just saying that when it comes to where we are, it seems like we've kind of gone from despair to now a hope phase. Where do you think we are in the Chinese equity cycle?
In the Chinese equity cycle, in particular related with the property sector, I think the divergence is going to continue. While we see low quality names and also some troubled companies like Shimao coming to the headline, we're going to continue to see that in the next 12 months because given there's a mounting repayment schedule. But also, we want to emphasize that for those high quality names and also for public enterprises, they are actually doing okay. Because overall, I think the property sector is still a very large and one of the most significant sector in China, in both China and the US or elsewhere. So I think there's going to be some government support and policy losing on that. So on China equity, since you mentioned, I think there's a lot of traders, even onshore traders, they are dumping the China mega names. But I think it's a quite seasonal, seasonal period. That's before Chinese New Year. Usually the liquidity has been very tight. As we can see, the PBOC dream some liquidity from the system. But I expect there will be some, liquidity injection in the next few weeks, just right before the Chinese New Year as usual. And also the Omicron, the new cases has been spreading out worldwide and also in China and Hong Kong. There's going to be some negative market sentiment maybe in the next few days, will be lasting for a few days, but I don't think it's going to be a permanent phenomenon.
Yeah, Wang Shengzu, just hold the thought. David here, by the way. We're just going to get just an update here on Shimao here. So the company is saying that it will continue talks with China Credit Trust. To your point, Shengzu, that this is a continuing story across the property space. It looks like we're looking at two camps, right? The high-quality names, which seem to be doing okay, to your point, and the market's trying to figure out what among the low-quality names, where there's value there. What would you be advising investors in terms of opportunity within that sort of hazy part of the property space, whether that's credit or equity?
I think on both credit, equity, and the low quality names, they are already trading at almost default levels in terms of stock and the bond prices. So I think I wouldn't say it's 100% pricing, but I would say at least 75-80% pricing. And as a Chinese investor, actually we are continuing to shifting away from the Chinese property sector in our portfolio. For example, the Asian high yield space, China properties is about 75% of the total market cap. But we follow the ESG standard, we capped to 45%. So that's why we continue to underweight China properties overall.
You're saying when it comes to tech, you see there's light at the end of the tunnel. We were talking to our markets correspondent, Sophia Jorge-Costa, saying, how long is that tunnel now, Shengzu? Because, right now, are you willing to call a bottom? You have mainland traders, they're, for the first time since 2018, have become net sellers of Hong Kong stocks as well, including the mega cap tech. How much visibility is there when it comes to the regulatory front?
Yeah, I think in terms of performance, the Chinese equity, including in particular Chinese tech stock, within the MSCI China has been a very terrible year in 2021. And the gap between, for example, the S&P 500 and China tech names has been historically high since data inception. So I would expect some sort of mean reversion or normalization in this year, given that, first of all, I think the company fundamentals and valuations are still look fair. And secondly, on policy front, we see too much emphasis over, for example, over control, regulation, the antitrust, data privacy, etc., instead of any support, right? But in this year, I think given that there's going to be a 20th, party Congress by the end of this year, similar to the Fed put, I expect some party Congress put there. So in both fundamental and policy support, I expect there will be some turnaround in this year.
And that goes into your projection here that growth is not going to fall below 5%. We've heard from the likes of Beijing. I think Henan province also came out with their guidance for the year, 7% for Henan. I think Beijing's at about 5%. To your point on the party puts, would that offset what a lot of economists are still pointing out to be a fairly weak year for Chinese consumption given COVID-0?
Okay. I don't believe China gonna grow below 5% this year for two reasons. First of all, let's record that in 2019, before COVID, China was growing at 5.9%, at which many people believe that that's close to China's potential growth. So I don't think after 2 years, even on the structural factors, for example, population aging or some damage from COVID, China's trend growth is going to be slowed down so much by another percentage point. Well, China could be somewhat below, the trend growth this year, but I think around 5% would be a reasonable measure from the fundamental point of view. And secondly, as I mentioned, they're going to be some convergence in stock market performance between China and the U.S. maybe at one space, but I see a policy divergence between China and the U.S. as U.S. is going to be tightening and also some normalization of monetary policies. China going to be loosening the policy in both fiscal and monetary front, and so the policy support and also support growth.
COVID-0, I mean, it's raised a lot of questions on whether it sparks a kind of a rethink when it comes to China. It's interesting that you mentioned that this policy actually contributes positively to the global supply chain. Doesn't quite kind of make it clear. Can you explain why?
It seems counterintuitive, because you see the headline news from the massive lockdown in Xi'an or compulsory testing in Shenzhen or elsewhere. China will continue to maintain the zero tolerance policy, in my view, for the next 6 months at least. But it just because of it's the containment or the limits just to certain region, it allows other parts of China to operate and to produce normally. Let's take one example, say 2 years ago, record that when Wuhan was in lockdown and during the Chinese New Year, and in Hong Kong, in the supermarket, people were running to buy toilet papers. Remember that, we see many photos. And why? Because they're all from China. If China cannot produce, it will be a real supply shock and disaster to the rest of the world. And now we don't worry, there's shortage of masks, ventilation machines elsewhere, because China maintain at least, for example, 90% overall capacity in production, going to contribute to the positivity to the global supply chain. Without that, I would expect inflation going to even go higher. So that's why I'm saying, some domestic costs of mass slowdown, but it's actually contributed positively to the global supply chain.